Hello traders, it's Tuesday, January the 21st. This is John Kicklighter, Chief Strategist for dailyfx.com, here with your FX market wrap-up for the opening 24 hours of this trading week, and an outlook for what we can expect in the coming 24 hours, and of course, looking beyond. This opening 24 hours was a U.S. market holiday, and I know it's only one section or one region of the global financial market, but it is an important one, and we often see when the U.S. markets are offline for a holiday, as much as we see when the European markets are offline for a holiday, it can significantly disrupt the transmission of risk trends, whether it be risk on or risk off. It helps to stall those kind of moves, or hurts if you are looking for bigger swings. And as shorter term traders, this certainly did hurt our market activity this past session. But we did have some relatively interesting moves from these baseline measures. So taking a quick look at two of my favorite primary gauges, the US dollar, as you can see, made a little bit of a pullback through the Monday session, but it really didn't meet a meaningful reversal, nor did it actually progress the bull trend, the slight bull trend that we have developed over the past couple of months. Now, this is actually another shift in activity level. Friday was a small range day. Monday was a small range day. When you have consecutive small ranges like this, you have some small congestion patterns. It often leads to a short-term breakout. That's a perfect condition then, because we have, as you see here in this larger pattern, some bigger boundaries, technical boundaries, that we can work our way through. A break to the upside that overtakes 10,760 on the dollar index would be a good follow through on the upside run. Though we haven't really had a lot of momentum to feed that kind of drive. Subsequently, you can also look to the move back to the downside. This previous range top down here at called 10,720 is now potential support. Break to that downside. It's easier to cover this channel, right, back to the lower end of the threshold, and mark that as a short-term break. Interesting technical setup. Oftentimes what happens when you have a market offline for the holiday, you see small moves, lacking trend, lacking amplitude for volatility, and more often than not, you have something of a corrective theme. So if the previous week was pretty consistent in the bullish area, bullish arena, then you often have a correction to the bearish side, although it's relatively modest. This is exactly what you see with the US dollar. Now, what about on the other end of the risk spectrum? All right, a theme, risk that hasn't really had much momentum behind it. Here we have the S&P 500 CFDs, which are futures-based. You can see that we actually did have a move to the upside, putting us right back into contention with this 18,050 level. Or 1850 level. A very noteworthy resistance, and the cap, or the current cap, for this ongoing move from the S&P 500. Now, you guys know that I have something of an issue with the consistency and persistence of this move. Of course, it will exist and last as long as it can. As Keynes said, the markets can remain irrational longer than we can remain solvent, so you don't want to trade against that prevailing trend, but you have to be exceptionally careful about the conditions that are supporting this pickup. When you look at the S&P 500 and the drive forward that we see, there are very substantial concerns here that we are in a over-leveraged position, and that there is a very substantial risk of a deleveraging or risk aversion theme that clears out a lot of this investment that is just there to reap a few pennies for substantially more risk. So in today's strategy video, and I encourage you to check that out, I covered specifically the possibility of a massive risk aversion theme, not just in the S&P 500, but market-wide. All right, here we have a nice measure of the S&P 500 versus all the corrections that we've seen since the 2009 bottoming back there in early March. All right, so the deepest we've got was a little over 18%. So we really haven't hit that 20% peak that is a meaningful bear wave. And we haven't had a meaningful pullback since the Great Financial Crisis. So we are going a long time without seeing a correction of that magnitude. There are a number of other considerations that we have to take in. All right, we in today's strategy video compare the correction, the possibility of a correction, market correction, to some historical patterns, like the market crash of 1929, the 1987 Black Monday, which is really a massive one-day decline, and gold's decline earlier in 2013, April 2013, and also in August 2011. All right, and we look at these and we see the kind of development that we can have play out. If it were a true risk aversion move, what kind of risk aversion theme would we have? Well, when you take into consideration the level of participation, all right, so if we look at something like volume and volatility, the participation is one aspect of this. The level of leverage is another aspect. We know that we have record levels of leverage and certainly exceptional exposure to riskier assets like investment grade assets, meaning junk grade assets. All right, so it creates a distortion in how these markets will act in a counter trend move, and it certainly can amplify the volatility and at the same time curb the progression of the bear wave. So you can watch more into that in the strategy video, but as of right now and as of this week, we are looking more towards the smaller moves that we had to open the 24 hours. This puts us directly in contention with resistance here on the S&P 500. This move that pulled us back a little bit puts us directly in conflict with short-term support, potential breakouts on both aspects, or both of these major measures. So be very cautious about how you enter your next 24 hours and choose your trades wisely. Now, in terms of what can catalyze a move of this magnitude, because remember, when we have trend development, we can have a breakout that really starts moving. It takes that technical cue and ramps up an existing fundamental theme, or you can just have a breakout that goes very, very slowly, if anywhere at all, after the technical move is made. All right, I think that we might trend more towards the latter scenario than the former scenario. In the next 24 hours of trading, we have relatively low-tier economic indicators. Now, there are two themes that I've generally been following, and I've mentioned them pretty much in every trading video, and that is risk trends, which have not been very prominent, and relative monetary policy. Now, relative monetary policy can also kind of spill over into the risk theme. All right, so when we look at the relative monetary policy, we can see where these different central banks and their respective currencies stand in the spectrum of dovish to hawkish. But we can also see that impact of monetary policy on something like expected volatility or risk-taking. All right, here you have the total stimulus of the major central banks around the world versus the VIX index, or we can look at it versus the S&P 500. All right, we know that this has a material connection to risk-taking, which is itself a measure of participation for the capital markets. All right, so you can see it in one of two ways, but it's really an escalation to spill the risk, the monetary policy consideration into full gauge risk. All right, so we have to maintain our expectations. And there really isn't much on the docket in the upcoming 24 hours that would stir the benchmark central bank's monetary policy expectations to the point where we're really talking about full-scale risk aversion. Always have to be aware of the unexpected. In past market corrections, bear waves, we actually had more than half of them were instigated by things that we wouldn't necessarily consider to be ground-shaking news. Just kind of slowly starts the flood or the snowball, and it builds with momentum. So it's always a possibility, but we have to run under expectations, reasonable expectations, what to expect going forward. So in terms of the major central banks that we're watching, I would say watch the Fed. All right, and the taper speculation. Taper speculation has been helping the U.S. dollar, and this past week the dollar has seen a big pickup on on the outlook and the bullish implications thereof, because we did have a number of policy officials, Fed speakers, come across the wires, reaffirming their dedication to a steady trend of reductions in QE3, or as they call it, the taper. All right, and that helped to offset or negate the risk that the big non-farm payrolls miss would mean to stalling that trend that began with December 18th when they first reduced the QE program by $10 billion. So we are a week out, or actually a week and a couple days. It's going to happen next Wednesday. But in that period before the actual FOMC rate decision, in which the market's still, I think, expecting another taper, you typically have a Fed official blackout period where they don't really update on their expectations. They don't really jawbone the market. So now we don't have much in the way of taper-based catalysts. We have to look for it where we can get it. One thing that I would point out is the Fed's primary dealer survey. This is actually a survey collected by the Federal Reserve, in which they take the expectations of the primary dealers, the major financial institutions that underwrite treasury auctions. So they're essentially the central bank's connection to, quote unquote, the market. Whatever their expectations are, they are taken into account, and they certainly do paint a picture for the broader market expectations, as well as what the Fed can derive from those market expectations. Certainly worth our watching. Doesn't necessarily mean it's going to be an absolute market mover. No, it doesn't, but it always adds to the picture, and you have to take that into consideration. I would also argue to keep a close eye on the euro. All right, from the ECB's perspective, we actually have had a couple policy officials suggest last week that there isn't a need for a new QE program from the ECB. They don't need another LTRO. And why would they? We've seen yields from the Eurozone drop at an incredible rate. All right. The euro itself is doing exceptionally well. The Spanish and Italian 2-year bond yields, which I flipped upside down here, are record lows. Everything seems fantastic. All right, this is absolutely a risky position. If volatility picks up, I can tell you right now that the European capital markets that have seen so much of a foreign capital inflow are going to be raised. All right, the markets are going to repatriate their capital, looking for safety, and certainly countries with record high unemployment rates, over 0.25% of the population, and exceptionally large debt loads are not going to be the source of those funds. So we'll watch this, but in terms of the individual pieces of event risk that we have on the docket, you do have some important updates like the Eurozone Investor Sentiment Index, but it's not going to be one of those definitive reads. Same with the Bank of England. Interest rate expectations have really been leveraged up by the pound traders and the gilt traders. We've seen the pound really take off since over the past 6 months, having bottomed out sometime in mid or early July. And the drive since then has been forcing the market to price in a rate hike sometime in 2014. Now, actually, there is now a leading consensus amongst economists, polled by Bloomberg, I believe, that they now expect that the Bank of England next month, when they update their quarterly inflation report, will move forward or update their forward guidance. So instead of their previous statement that they expect to hike rates sometime in 2015, they might actually move it up to 2014, or at least that's what they expect. If instead they say, well, we won't necessarily move to hike rates even if we hit 7%, that could actually deflate this market significantly. But in the meantime, data becomes more important. All right, we're going to see if indeed we can hit those thresholds, at 7% unemployment threshold that they're looking for. We'll be looking for business confidence figures here, and the CBI's manufacturing activity report. And then, of course, on Wednesday we do have the employment figures and BOE minutes. So big event risk for pound trades. If you are in any kind of pound trades, be very careful. I do have a pound trade that I took, euro pound, largely for the technical basis, but at the bottom of this descending wedge pattern, we'll see if this is definitely going to be an exposed currency pair to this upcoming event risk. If the data is both good and the minutes are somewhat inflammatory, So they start to talk a little bit more hawkish. Expect the pound to take another run higher. Pound dollar could potentially move to the upside, overtaking this previous swing high at the very beginning of the year. Funny how the pound tends to make absolute tops at the very beginning of years. All right. Here is 2014. There's the top. Here's 2013. Here's the top. Will this necessarily be a top, though? That's what we're looking for. Just something to point out. All right, but pound certainly has its exposure, and it's especially strong exposure if the UK, or at least the markets that trade the UK, start to pull back on their outlook for rate hikes. Now, rate hikes have certainly been leveraged for the New Zealand dollar, and this actually goes back to some event risk that we've had to open this morning session, Tuesday. The New Zealand CPI, fourth quarter figure, it was only modestly better than expected. All right, if we look at the data, a 0.1% increase on the quarter, though we were expecting a 0.1% contraction in price pressures. The annual CPI figure actually increased to a 1.6% clip, just modestly better than expected. And what happens to the New Zealand dollar in turn? Well, the Kiwi dollar, US dollar surged higher. All right, you had a Kiwi yen rally right back after breaking this into Friday, and it was trading most of Monday down here, and had a rally right back to where we are now. Aussie Kiwi was making some progress to the upside here. It came right back down, and it also hurt my Euro Kiwi long, trading off the bottom of this rising trend channel. This pair has come right back down to the channel support, right, the zone support, and puts my trade in jeopardy. All right, and all this because of a piece of data that came in largely in line with expectations. All right, what did it do to interest rate expectations? Well, we already knew that the RBNZ is leaning towards rate hikes. All right, in fact, the RBNZ Governor Wheeler suggested that back late last year that he expects to raise the benchmark lending rate some 225 basis points, or 2.25%, by the first quarter of 2016. All right, that's a really aggressive pace, considering that almost every other central bank is debating on whether it would even need to hike rates within that time frame. All right, the RBNZ is way ahead of the curve, yet the market has diminished those expectations somewhat. They have reduced the impact that those expectations have had on price action until recently. You have seen that the Kiwi now is making some much better progress on data that is otherwise mundane. This is what we call a bullish market. All right? When the market is leveraging the impact of positive data and reducing the influence of negative, quote-unquote, negative data, right? That's a bullish market, and vice versa, of course. So what is the market looking at right now? Well, the 12-month interest rate forecast is back up to about 119 basis points, so that means by January 2015, the market is pretty confident and almost certain that the benchmark lending rate, which is currently 2.5%, will be up to 3.75% by January 2015. That's aggressive. No other central bank has that rate forecast. All right, but at the same time, the market's been pricing this in for some time. In fact, we've been up here since late December. All right, so does this data, which is only moderately better than expected, significantly change the outlook? No. Does it get more traders on board with the expectations? Yes, it does. All right, so we have to see how much influence this actually has. In terms of the probability of a rate hike next week, actually on January the 30th, right, so Thursday of next week, you can see here that swaps, overnight swaps, are pricing in a approximately 47-48% probability that there will be a hike. All right, so that is quite remarkable. This would be the first rate hike. If these expectations start to pull back, however, be very careful. The Kiwi can suffer for it. And the Kiwi has been knocked around a little bit as of late. Kiwi yen is, of course, following interest rate expectations for New Zealand dollar, but the only reason it's able to do this, and it's been allowed to pay attention to this, is because risk trends are also positive. as the Nikkei 225 rises and the S&P 500 pull back up, the yen crosses are allowed to move higher. All right, and you've seen the dollar yen move back into this kind of trend line resistance here. Breaking 105 would be a significant progression point, but can we continue along with a positive risk bearing? And remember, it's not necessarily just risk that's going to be able to accomplish a meaningful break for the yen crosses. All right, the S&P 500 breaking above 1850. Don't be too surprised if the yen crosses lag that move, and if they don't even find the necessary momentum to muster new multi-year highs of their own. All right, because we also have a competing factor, a competing interest in the BOJ rate decision, which comes out early Wednesday morning. This is going to be a very important piece of data because the markets have grown a little bit skeptical that the Bank of Japan is really going to commit itself to devaluing the Japanese yen further than where it's already at. Of course, their open-ended stimulus program is quite remarkable. However, they have been backing off of the pressure, and now there is concerns about something of a QE trap in eventually pulling out of this massive stimulus program, as it could significantly increase longer-term rates and create a global confidence crisis in Japanese government bonds, because they are not providing the yield necessary to really hold on to them while the rest of the world is starting to see a rising yield as well. So this is a longer term issue, but in the meantime, we have a little bit of buoyancy from the risk themes. S&P 500 and Nikkei 225 gave a bounce to the dollar yen, certainly leveraging the Kiwi's performance, and you saw a bounce up here. The trade that I was looking at was actually, it was more of a basis on the Aussie dollar, but as you can see, the Aussie yen pulled right back to the bottom of this wedge. I was watching this, I was looking at it as a potential trade, but I got a little greedy after I saw confirmation. I put an entry somewhere down, I believe at 91.25, and good for one day, and it just kept going. All right. It's a little bit greedy, but I do not regret it at all. I want to make sure that I have good entry and that I also have confirmation. So it left me behind. Will I trade this if it gets back down there? No, it's a brand new trade. I'll have to reassess the situation. But for those that took, and I know that a couple of you did, great trade. Great trade. The euro yen is another very interesting one. And a lot of people have been talking to me about this being a major head and shoulders pattern. It does fit the bill for the head and shoulders pattern, actually a descending neckline here at about 140.50 is now where we stand with that neckline. But this was a big, massive run up, all right, and it does look like it is ready for a break. All right, but these yen crosses absolutely must have a catalyst to the downside. The Bank of Japan is a constant pressure for the yen crosses to advance. This is going to be a buoyancy factor, and it will be something that pushes us forward. On the other hand, if risk aversion kicks in, all right, we have this unwinding. These yen crosses are all ready to go, and if that's the case, euro yen once again looks like it's taking top spot for the technical peel. It also has a very hefty fundamental backing if it does start to break down the lows. But until that happens, it's not worth trying to preempt such a move, because as the trend suggests, we continue to move forward pretty consistently. All right. A quick look at some of the majors. I am still keeping my eyes on the euro dollar after we made that trend line break into Friday's session, and we have so far held below that trend line. However, persistence to the downside is a little bit more problematic to develop, because with the euro, while I am extremely dubious of the fundamental appeal of the currency and the excessive capital inflows into the country that have driven the periphery bond yields to such lows, it can continue unchecked for quite a while. All right, so this is going to be a risky situation, and there isn't much in the way of definitive catalysts for the Eurozone. While we do have some UK data this week, and maybe even arguably some US data, and of course the Bank of Japan rate decision, we don't really have something on the Euro side that says this will definitively alter the rate forecast for the Euro. All right, so I want to be very cautious with this one. I don't want to move on this one if I don't have to. Pound dollar, you know my technical beliefs. I think that's a great looking head and shoulders pattern, but you got to be careful because we do have that BOE minutes and jobs data coming up, and the market is certainly very hawkish on what's going to happen with the Bank of England. The dollar yen, I'm going to stay on the sidelines. If risk aversion kicks in, then I'll probably defer to the euro yen. That would be my preferred trade. Other than that, this could be a consistent move to the upside, but I need something that really reasserts the taper expectations and revives confidence in the Bank of Japan's commitment to devaluing the Japanese yen. Aussie dollar. This one actually has a little bit more interest to me. Now, the Aussie yen, which I missed because it made its way consistently, this was my alternative view. If the Aussie dollar did bounce and covered some ground, if it gets into some previous support as new resistance and then makes another bid lower, well, I see a couple waves that already suggest what can happen as we continue back to the downside. So I will keep a very close eye on this development. A move to the upside I'm not even going to consider until we get somewhere in the vicinity of 90 or 90.50. Then we might possibly get there, but even then you need to have something that really diminishes taper and really drives risk appetite, which is difficult to do in these market conditions. Much easier to maintain a healthy caution on risk trends and undermine the RBA's interest rate outlook while also feeding taper speculation. All right. The last thing I want to look at in today's video is a quick view of gold. All right. I noted this twice, both this past session and early Monday morning, because I was watching these markets really closely with the Chinese GDP data. But gold here is testing a very significant resistance trend line, all right, and we are right there. And it falls, I would say, at about 12,060, 1265. If this rejects this move and we start to break down, this is a good hold and potentially a bearing for continuation to the downside. But if we break to the upside, you definitely can see speculation from the pure traders, momentum traders. If we start to see some short covering build up, that is already being suggested. If you look over at how speculators are positioned, here's the COT figures, and those shorts are starting to pick back up. All right. Now, if we cover some short stops or we fill some entry orders, it can start moving to the upside. But remember, gold's most prolific moves are the ones that run opposite to what the US dollar is doing. So if you don't really see a big drop from the US dollar, limit your expectations for gold to the upside. All right. We'll wrap it up there. There's some upcoming event risk, but it's not the top tier event risk that we're going to be looking for. We got to get into Wednesday morning and for the Asia session, the Bank of Japan rate decision, and then we really start getting into the big event risk, but we'll cover that in tomorrow's video. Until then, good luck trading out there.